Good evening, ladies and gentlemen. Thank you for joining us for today's webinar. We'll be talking about bonds and specifically these two questions highlighted here. So, will bond yields continue to rise and how can investors cope with it? So, today's session, we have two of our analysts with us, Tan Chuan as well as Jackson Tan. Yeah, so without further ado, I'll pass time now to Chuan.
Good evening, everyone. So today's agenda will be our macro outlook for bonds and also our expectations on yields, and also some bond ideas for investors to invest in this rising yields environment. So first, let us take a look at the relationship between inflation rates, interest rates, and bond yields. So across time, they are all positively correlated, with the 10-year US Treasury yields acting first as they are influenced by investors' expectations of growth and inflation. So as you can see in the chart, the blue lines, they tend to increase or decline first. So because the markets are based on expectations. If you look at inflation rates and interest rates, they are closely interlinked as the Fed adjusts interest rates to control inflation rate. So the current question is, where is inflation heading? So if you look at a few economic indicators, we see that manufacturers are actually paying more for their goods. Manufacturing prices are also increasing, and they are closely related to inflation, as if these prices increase, then your cost of goods sold also increase. So at the end point, consumers can find higher consumer prices as firms increase their final prices. So as you can see from these charts, the manufacturing prices are a leading indicator for inflation rate. So we might be seeing high inflation in the next few months. If you look at US small caps, they are also looking to increase their prices. Considering that small businesses make up a large part of the US economy, when they raise prices of goods will increase too, along with inflation. But we have to remember that we are at a 1-year mark of global lockdowns, meaning that we will most likely see higher year-on-year inflation ahead due to lower prices or the fall in prices last year. So it's better for us to look at month-for-month increase in prices for the next few months. Fed Chairman Jerome Powell has also said that the Fed has accounted for this phenomenon. So under their new average inflation target framework, they're also likely to tolerate a core inflation rate of about 2 to 2.3% for a few months. In their March meeting, they also said that they will wait to see actual data, signaling that labor data and inflation data has to sustain for a few months or maybe half a year for the Fed to act, instead of raising interest rates based on more positive forecasts. So if you look at the chart on the right, then you will see that many jobs have been lost during the pandemic, and the recovery is still quite far off from what the previous situation was like. So we have to wait for the labor market to recover according to the Fed in order for them to increase interest rates. But if you look at Fed officials, a few of them have turned more hawkish in March. So if you look at this dot plot, then you will see that in March, there are more Fed officials expecting rate hike by the end of 2022 and also by the end of 2023. So the yellow ones are the March meeting dot plots, and the other one is the January meeting dot plot. If you look at investors' expectations of a rate hike is still low. So typically, the Fed increased interest rate by 25 basis points. So if you look at the left-hand side axis, then the interest rate is actually still very low, way below 25 bips. So 1 week ago, investors are virtually expecting no interest rate hikes for the whole of this year. If we look at US Treasury yield curve, the Fed seems to have anchored expectations very well with investors expecting interest rate hikes at least 2 years from now. So the current yield curve is the one that the red arrow is pointing to. So if you look at the midterm to the long-term US Treasuries, like the 5-year onwards, then you can see that investors are expecting better economic growth ahead. So what we want to see is the whole yield curve shifting upwards, similar to the shape in mid-2016. And when interest rates rise, then the yield curve will shift upwards to something like that of mid-2018. So in this scenario, banks will benefit because of better net interest margins. So what does all this mean? We know that long-term growth expectations are back. That's why the long-end US Treasury yields have been increasing. And most people are expecting 0 to low chances of rate hikes in the next 2 years. But the question is, how high can yields go? So if stock markets had a V-shaped recovery last year, then it was also possible for bond yields to have a recovery, but U-shaped due to the nature of time. So if the 10-year US Treasury revert to the mean of about 2% yield, then we will see long-dated bonds continue to fall in price. So if you look at the left-hand side chart, we have US Treasury yield, 10-year US Treasury yield inverted. So when US Treasury yield increases, then the prices of US Treasuries will also tend to fall. So if there's a revision to the mean, then we will continue to see the Treasury prices falling. We also see term premium finally reverting back to positive again after being negative since 2018. So typically, investors demand a premium on longer dated bonds because there is more uncertainty surrounding these long-dated bonds. The term premium can also be thought as the residual after subtracting forward expectations from the 10-year US Treasury yield. So the very long-term average term premium is at about 1.76%, but the average since quantitative easing started in about 2009, 2010 is at 0.6%, which is where the term premium is at now. Unfortunately, it's hard to say which of the means the term premium will revert to, but we think that it will most likely exceed the mean since 2010. So if you look at real 10-year US Treasury yield based on core CPI US, then it has only turned positive recently. Inflation continues to rise and mean revision continues for this real 10-year US Treasury yield, then we can expect nominal yields to further increase, which means further downside for long-dated yields ahead. So the average since 2010 is 0.4, and the latest as of 23rd March is 0.12%. So we might still have some way to go for nominal yields, and even more if inflation is above 2%. So vaccines are also working very effectively as seen in Israel and UAE, where infection rates have declined sharply as the countries vaccinate more of their citizens. And this is very good news, as the faster the world populations get vaccinated, the earlier we can resume our pre-COVID lives. So this will be a boon for global economic growth too, and higher growth will also indicate higher yields. So in the longer term, long-term yields still have a high chance of increasing. In the short term, volatility in the financial markets could cause risk of sentiment, which may lead to an increase in prices, but we think the overall direction is up for yields. So we prefer short duration bonds because they are less sensitive to interest rates changes, and also high yield bonds. If you look at the graph, you see that the US high yield bonds have actually performed much better than the US investment grade bonds since the start of this year. And then an unexpected interest rate hike can also benefit banks. So now to bond ideas. Our favorite sector, Chinese real estate sector. The default by China Fortune Land has struck fear in the Chinese real estate sector, with the spreads of B-grade Chinese real estate bonds increasing, but recently they have fallen quite a bit. So high yield names actually look more attractive now. We have 3 names for you, Fantasia, LVGM, and Evergrande. So we like Fantasia because of their strongest liquidity profile. If you look at the cash to short-term debt, they have enough cash to meet all their short-term debt. So, and its last period to maturity is at about 9%, with only 1.26 years to maturity. So with this is, I think it's a quite good return for bond investors. looking at LVGM, they should be able to meet their debt obligations through asset sales. And for Evergrande, if you look at the credit profile, then they have quite big credit profile as compared to the other two real estate developers. So we are only positive on their short-term bonds, which is the 8.25% bond maturing in 2022 with less than a year left. So next we have Lipo Malls Indonesia Retail Trust, also known as Lemire Trust. So they have 22 malls and 7 retail spaces in Indonesia. They are located mainly in Greater Jakarta, Bandung, and other cities. Their sponsor is Lipo Karachi, whose director is John Rayadi, and they are rated B1 by Moody's. So for the fourth quarter of 2020, they had a smaller decline as compared to third quarter 2020, which total gross revenue declined by about 58.3%. But for the whole year of FY20, their total gross revenue declined to 148.5 million Sing dollars, which is about half of that in FY19 due to the lockdown. So the malls and retail spaces closed at the end of March 2020, but all malls and retail spaces have reopened since July 2020 by shorter operating hours. Recently, their operating hours have increased to 10 to 11 hours. Previously, they were at 8 hours. So the management expect rental reliefs and operating conditions to continue to at least second quarter of this year, but they have lowered their discount since January 2021 due to improving conditions. For net property income, it came in at 10.636 million Sing dollars in fourth quarter 2020, and their total loss before revaluation and tax totaled to about 6 million Sing dollars. They were met with a high fair value loss and divestment of about 212.1 million Sing dollars, which resulted in a total loss after tax of 220.2 million Sing dollars. So because of negative distributor income in third quarter 2020, Lemire Trust was restricted to make distributions to both perp holders and unit holders. So they chose not to pay coupons for the 6.6% perp in December last year, but an equity injection allowed Lemire Trust to circumvent this restriction. So the equity injection was due to the acquisition of Lipo Mall Puri, which they acquired for 330.2 million Sing dollars. They also signed a vendor support agreement of 340 billion rupiah per annum with Lipo Karachi. So the rights issue of about 280 million Sing dollars allowed Lemire Trust to pay distributions, and the December coupons, which were not paid, have been paid in February. So these restrictions have been lifted, and the rights issue have provided a big buffer for potential losses in the future, which is quite unlikely in our view. So if you look at their fourth quarter net property income, which is about 10.6 million, and if we add the Lipo Mall Puri vendor support agreement, and with better operating conditions now, we expect Lemire Trust to post a small profit of about 2.5 million Sing dollars per quarter. So if you look at the debt maturity profile, they have paid off all 2021 loans of about 290 million Sing dollars, and they also have enough cash to meet their 2022 debt. So the next biggest hurdle is their 2024 bonds. The interest coverage ratio of about 0.91 times is a cause for concern, but as said earlier, operating conditions have been improving, so earnings should be improving for this year. Gearing ratio is at about 42.4%, which remains at acceptable levels according to the management. So the new issue was met with high demand, it was oversubscribed, and the new credit facilities also indicate good refinancing ability, which means good news for their fixed term bonds. But we like their perps more, especially the Lemire Trust 6.6% perp, which is available on Bond Express. So this perp was the one that missed coupon payment last year, and it will most likely only be caught if they can refinance at similar coupon rates, because their reset rate will be much lower than 6.6%. And management has also indicated that they will not call at the next call date. But if you look at the yield to call at various call dates, then we see that even if the bond is called at December 2027, we still get a good yield to call of about 13.6%, which I think is extremely attractive for a perp. So with that, I've come to the end of my part, and I will now be passing the time on to Dexter.
So I'm Dexter. I'm a senior fixed income analyst at IFA's fixed income research. So not only we think that Chinese real estate and Lippo malls is attractive, there are a few other sectors which we think are also attractive at this point in time. So one of them is banks. So this is a very familiar sector which all of us are very well aware of. So if we look at banks, so in a typical banking model, we have the depositors. So the depositors are actually on the right, on the left here. So these are your depositors. And then they deposit cash into the bank. And in return, the bank pays them a deposit rate. So when you put money in a bank, you get a deposit rate, right? So for now, maybe if you put in Sing dollar deposits, it will be as low as 0.5%. Or in some other countries, you may get 1%. And then what the bank does with your money is that they take your money from deposits and they issue it as loans to companies and individuals. So these would be loans, and then the individuals and the companies, they will pay a mortgage. So this mortgage rate or this borrowing rate from the company can be as high as 4% or even more or maybe less. So as long as the bank makes a profit, that means they borrow from you at maybe 0.5% or 1%, and then they lend it out at a higher interest rate of 4%, so they earn the spread. Okay? So this is basically what a typical banking model is. So that's how banks earn money, and the spread differential between the deposit rate and the lending rate is essentially what we call as the net interest margin, or a proxy for the net interest margin. So now most banks have this kind of balance sheet. So as bond investors, we would like to be interested on what is a typical balance sheet of a bank. So we have the assets, which is made up of cash, investments, and then loans to customers. So the cash comes from either the depositors or the central bank, and then the bank can also make their own investments. So they can also invest in stocks, they can invest in bonds or even funds, and they also lend, as mentioned earlier, they lend the money to loans to customers. So these are considered assets. They are assets because the loans pay an interest rate to the bank, and they actually help the bank to make money. So, and then at the bottom row, we have the debt. So the bank has debt, like they can issue debt to bond investors like you. So if you buy a bank debt, you actually lending money to a bank. So you can buy the senior bonds, or you can even buy the perpetual securities of a bank. So the bank is actually obligated to pay you back your money at a certain point in time in the future, and then between now and that point in time in the future, they will pay you interest on a regular basis. So that's the debt, and it's recorded as a liability on the balance sheet. So there can also be loans. So loans are not securitized, unlike debt or bonds. And then, of course, we have customer deposits, which are also liabilities of the bank. So these customer deposits, as I showed you earlier, is a liability because the bank they're supposed to pay the depositors interest rate, so it's 0.5%, so which is why they're recorded as a deposit. So if you take the assets minus away the liabilities, you get the middle row, which is the equity portion of the bank. So this equity portion can be made up of retained profits or even injections from shareholders or injections from investors. So this middle part here is the equity portion, and it actually acts as a financial cushion against losses. So if the bank is in trouble, they will have to write down their capital or even take a hit to their common equity tier 1. So within this capital portion, there's actually tier 1 capital as well as tier 2 capital and other regulatory capital. Okay. So when we look at banks, there are a couple of measures we look at. So one of them is profitability. So within profitability, there is return on equity. So this is essentially taking the bank's profits and then dividing it by the equity value of the bank. And what I've done here is I've shown the various ratios for 11 banks. So the names are actually on the chart. There's Commerzbank, which is a German bank, Credit Suisse, Deutsche Bank, HSBC, Lloyds, SocGen, Standard Chartered, UBS, DBS, OCBC, and UOB. So we're all very familiar with the three Singapore banks, and essentially these are all very big banks that they're mostly made up of bond issuer universe. So most of the issuers, the issue bonds are typically these few banks. So look back to the point on return on equity. So if we look at return on equity, we have 3 years of return on equity. So this is a measure of profitability. So looking at 2020, we see that profitability has, I would say, moved lower for most of the banks. Deutsche Bank has profitability has actually improved. If you look at Deutsche Bank's example in 2020, whereas most other banks have actually declined in 2020, and that's because first of all, net interest margins have fallen. If you look on the left, net interest margins, which actually help to determine the interest incomes of these banks, have generally fallen because, as you know, interest rates have been lowered, and as a result, the banks cannot command such a high interest rates when they lend to customers. So there is one reason why ROE has fallen, but there are some instances. For example, UBS is also whereby it's detracted from the norm and actually recorded higher return on equity. So in general, I would say profitability has declined, and that's a result of lower interest rates, and also as a result of higher credit provisions. So when we look at the loan quality for most banks, they have taken some write-downs because they expect loan losses, given that 2020 was a time where, as you know, we had the pandemic and the loan quality has dropped, and which is why they recognize lower profits. But of course, in future, they can also reverse these provisions, meaning they can actually, there is a possibility we could see higher profits in future. So anyway, back to this point, which is cost to income. So cost to income is also another technical term, which when we look at bonds, we also want to consider cost to income, which is the cost over income. So as you know, a bank has most of its assets are actually human capital. So operating cost is actually quite important to the bank. So it's always good to keep a low cost to income ratio. And if you look at the banks, most of their cost to income ratios are pretty much flat for the past 2 years. So from 2018 to 2019 to 2020, cost to income ratios were pretty much flat. If you look at Deutsche Bank, the gray line, Deutsche Bank's cost to income ratio actually dropped in 2020. And that is probably why we also see an improvement in Deutsche Bank's profitability, as I showed earlier in the return on equity. So the other point that I would like to make is if we look at cost to income ratios for Singapore banks, which are the last three lines here, the last three lines, OCBC and UOB, they have very low cost income ratios. So unlike European banks, Singapore banks have actually very low operating costs. And on the chart on the right is another proxy for return on assets. So it's profitability, just that instead of dividing it by equity, we divide it by assets. And we also see a similar kind of trend here whereby return on assets are actually falling for 2020. And that's generally the case for most banks. So of course, one point to note is that actually Deutsche Bank has actually seen a higher return on assets in 2020. So just a caveat here, I would like to mention that these estimates are actually taken from Bloomberg. So this is actually Bloomberg's estimates. So besides profitability ratios, bond investors, we also like to look at capital ratios. So capital ratios are actually imposed on the banks. So some of you may know this during the Great Financial Crisis. There was a banking crisis in 2009, and then the governments had to bail out some banks, and they realized that the banks were taking too much risk prior to the Great Financial Crisis, and as a result, they went out of hand and they took on too much risk, and they did not have sufficient capital, and as a result, the governments had to bail out the banks at that point in time. But so since then, they have realized there is a need to actually boost the balance sheet of these banks, and which is why the Basel Committee has actually recommended, the banks need to have higher capital to actually absorb losses, which is why we have these capital ratios. So on a regular basis, the banks have to adhere to certain capital ratios. So one example is tier one ratio and total capital ratios. So if we look at tier one ratio, which is measuring the amount of tier one capital on the balance sheet. So it's tier one capital divided by risk-weighted assets. And you see that generally tier one ratios are actually increasing in 2020. So this is a good thing for bondholders because capital the bank's balance sheet is actually getting stronger. With the exception of UBS, as you can see, UBS tier one ratio has dropped in 2020. But if you look on the right, total capital ratio, which is the sum of tier one and tier two, is actually improving. So for UBS, tier one ratio has dropped in 2020, but total capital ratio wise, the UBS total capital ratio has actually increased. And the reason being is because there's actually, just by inferring that the UBS has probably a higher proportion of tier twos. And because they have a lack of tier ones, maybe we could see an issuance from UBS in future to boost their tier one, to meet their tier one capital ratio. They would issue additional tier one notes. So these will be perpetual securities to boost their capital minimum requirements. So anyway, generally for both total capital ratios and for tier one ratios, we see an improvement in the capital adequacies of these banks. So that's a good thing as for bond investors. So one of the commonly referred ratio for credit is common equity tier one ratio. So I think if you read credit reports, you come across this ratio quite often. Common equity tier one is the highest quality of capital within a bank. It's usually mainly made up of equity, total equity of the bank. And this is divided by the risk-weighted assets. So if you look at the trend for these 11 banks overall, we see that there's always an improvement of year on year on every year basis. So we can say that common equity tier one ratio is actually improving. So this is another good point for bondholders. So I'd like to mention that HSBC has a pretty high common equity tier 1 ratio, as well as OCBC. Then for Deutsche Bank, it's pretty much in the middle of the 11 banks. Okay, here we have a slide of the capital levels of the bank, the 11 banks. So we have common equity tier 1, but on an absolute basis, meaning you see how much common equity tier 1 and how much cash they have on their balance sheet. So the reason why I show this chart is because, as you know, recently we have some news about the banks, about like Credit Suisse having exposure to a hedge fund that has got into trouble, like I think it's Archegos Capital, pardon the pronunciation. So I think the news, it's still a developing situation. So at this point in time, we do not know the exposure yet. So, but I think if you read the news sources, they estimate the exposure to be about 3 billion to about 4 billion. So if we look at the common equity tier 1 ratio for Credit Suisse, it's 32 billion, meaning they can actually absorb this 32 billion of some kind of buffer. So they will be taking a hit to their common equity tier 1. So I would say 4 billion out of 32 billion. It's not really a material number. So even if we look at the cash of the bank, they have 128 billion of cash. And I would say it's not significant. I mean, at this point in time, of course, the situation is still developing at this point in time. And then we also have other exposures to green seal and all that. So I would say it's not a material event if we look at the common equity tier 1 of these banks and how much losses they have to take. I would say that banks are still in a relatively healthy credit position. Okay, so given the increasing capital ratios, the slight dip in profitability, and the possibility of maybe reversing credit provisions in future, and even the possibility of higher profitability in future, we'll be recommending the higher yielding securities within the bank's capital structure. So when we say that rising yields, we think there's a possibility that that yields may increase in future, and therefore we will want to invest in higher yielding securities within the bank's capital structure. So one of them is US dollar denominated perpetual securities, and these are the indicative yields to us. So meaning if you buy these bonds at maybe on the 26th of March, maybe if you buy the Deutsche Bank 4.789% perpetual US dollar note, you would get a yield of probably around close to 5%, I would say. So we'll be recommending the Deutsche Bank perpetual US dollar note. As mentioned earlier, Deutsche Bank has seen an improvement in profitability. Also, if you see here in this diagram, we also highlighted the Lloyd's 12% perpetual note, which has a yield of about 8%. But we're not exactly looking at Lloyd's at this point in time. That's because this bond here, even though it has a very high interest rate, so it's 12%. So 12% is quite rare for a bank. So the reason being is because Lloyd's actually issued this note in 2009. So that at that point in time, the bank was getting bailed out, and they actually issued a very high yielding note to the market. And it's been held on their balance sheet to this day because it's callable in 2024. This bond is very actively traded, no doubt, but this is actually a legacy tier 1 instrument, meaning if you read the prospectus, the issuer actually has the right to call back this note at 100 by the end of the year. So right now it's trading at a premium. No doubt the coupon is about 12%, and it'll be attractive, I think, if it falls maybe around 109 or 108, depending on the time. So you need to draw a line to gauge the attractiveness of this note. But anyway, we think that the issuer can recall the note at 100. So right now it's trading at a premium. So which is why we are not recommending this bond at this point in time. So anyway, moving on to Sing dollar. So US dollar by Deutsche Bank 4.78%, 7.89% per. For Sing dollar, we are recommending the 4.7 Perpetual HSBC. So HSBC is a very large bank. I think if you noticed earlier, it's one of the bigger banks within the 11 banks, just by looking at the amount of cash they have. And HSBC, we also see that the CET1 ratio is also among one of the highest among the 11 banks. Okay, so besides banks, Chinese real estate, and LMIA, we also think that agriculture will do well. As you know, commodity prices have increased. If you're going to have a resumption of travel activity, there'll be more planes flying. There'll be more demand for travel, and this will burn fuel. So, and commodities would be in favor. Agriculture will still in favor. There's people realize there's a need to actually keep food supplies at a healthy level during the pandemic. So there will be a demand for agriculture. So if you look at the prices for agricultural futures contracts, generally they have been increasing over the past year from 2020 March until 2021. So here I've shown here we have coffee prices, palm oil, corn prices, soybeans, and even agricultural prices. So generally I would say agriculture prices have actually increased by some, like if you look here on this chart, palm oil has increased by almost 50% since March 2020 last year. So it has gone up by 60%. And even for like soybeans have gone up like maybe 50% or more. So there's so companies that will benefit from higher agricultural prices. One of them is a bond issuer named Olam. So this is a issuer which we have repeatedly highlighted over the past couple of months. For those of you who do not know about Olam, it's market-leading food and agribusiness company providing food ingredients, feed, and fiber to over 25,000 customers worldwide. So some of their customers include Starbucks, Nestle, Kraft. So these are big Fortune 5. These are big companies, and Olam is actually one of the biggest 30 companies on the Singapore Exchange by market capitalization. So another thing to note, which is a big positive, I think, in my view, is that Temasek is actually a 53% shareholder in this company. So as a bondholder, you like to know that there's actually a large institution player who actually has a big stake in your company. And if need be, there is a probability that the issuer can actually have some support from the large institution like Temasek. So there's Mitsubishi also invested in the company. They have a 17% interest in the company. So just to look at some of the results for Olam, sales volume has increased from 39 million metric tons in 2019 to 44 million metric tons. So there's an improvement, and it's a sign that they are actually doing better in 2020. So most companies would not have done as well as Olam, but Olam is an exception. In terms of revenue, 32 million increased to 35.82 billion. 32 billion, sorry. So if you look at what this number means in perspective, the revenue is actually higher than the total income for DBS. So actually, Olam's revenue is higher than DBS total income. If you look at EBIT, which is earnings before interest and taxes, EBIT is about 1 billion on a yearly basis. And they actually made lower profits, still profitable, just that profits is lower for 2020 to about 178 million. And this is because of a write-down impairment. The company actually took an impairment on one of their assets in Gibbon, a palm oil asset. So they were supposed to get it running. They invested in an irrigation project there, and because of delays in the project, they had to take a write down on the asset, on the carrying value of that asset. So it's nothing to do with their operating business. It's just that they took a one-time impairment, and as a result, we see a lower profit for this company. So in terms of gearing, Olam gearing is about net debt to equity is about 1.5 times. It increased to 1.72 times. Net debt is taking debt, subtract away your cash, and you divide it by equity. So I would say something below 100 is reasonable. Of course, gearing is not that high if we look at adjusted gearing. So what is adjusted gearing? Adjusted gearing is you take net debt and you subtract. So not only you subtract cash, you subtract the receivables, which are secured, and some of their inventories, which they can actually liquidate for cash. So those can be counted as liquid assets as well. So we adjust the gearing and it will fall to 0.63 times. So that is still decent. If we look at EBIT, the company's ability to cover interest. So as bondholders, we always want to know that our interest is being covered, because they pay interest expense, right? Every half a year, they pay interest expense to bondholders. So we look at their interest servicing ability. So this is one way to measure it, EBIT over interest. So it's about 1.98 times, and that is indicative of a healthy company because the earnings is 1.8 times the interest expense. So now we look at the balance sheet, looking at how much debt the company has and how much assets they have to cover their debt. So as bondholders, we would like to know that, the company has actually more assets than their liabilities. So looking at the current borrowings, they have about 6.47 billion of current borrowings. Non-current borrowings about 6.8 billion. Perpetual securities. So if you buy the Olam perpetual securities, they will also be consider them as liabilities. So we add them here as part of debt. So to meet these obligations, the company can actually draw down on their bank lines. So they have about 7 billion. They can use the 7 billion to pay down their debt. They can also use their cash, and as mentioned earlier, their receivables are secured, and they also can liquidate some of their inventory. So they can actually, there's sufficient liquidity available to the company to meet their obligations. So we think that the securities of the company are attractive. So within the company's capital structure, we like the 5.375% perpetual Sing dollar. So it pays a yield to call of about close to 5% at this point in time. It's trading at above 100. So with that, here are the recommended bonds in case you missed out. We are recommending the Fantasia 2022, the LV Jam 2023, the Evergrande Day 2022, which has a yield to maturity of about 12.49%. So, and that is less than 1 year away. So if you look at this bond, and then we have Lemire, which Truran has highlighted. It may not call, but if you look at the valuation wise, it's attractive. You mean yield to call of 32% is really attractive. I mean, and if you look at Deutsche Bank, 4.789% perpetual. The yield to call is about 5.68%. HSBC, which if you have Sing dollars, then you may want to consider the HSBC 4.7 Sing dollar perpetual with a yield to call of 3.43%. So also callable in about a year's time. And then we have Olam. So I've highlighted earlier Olam, the perpetual, which we are recommending is the 5.375% with a yield to call about 4.97%. So these are, I would say, high yielding securities. Some of them have, I would say majority of them have short durations, and which is why these are better for a rising yield environment, because you want to receive a higher income on your investments, given that yields actually may increase. So with that, I come to the end of my presentation. Okay, with that, thank you very much for joining us today. We look forward to seeing you in our next bond seminar. Thank you.
All right, so thank you for joining us for this webinar today, and also once again thank you for our analysts who have given us that presentation. That's the end of our webinar today. So thank you very much, and have a good evening.